Good morning and good afternoon. Welcome to Treasury Strategies' 10th quarterly cash briefing for the UK, Eurozone, and North America. I'm Moni Lindsay, Managing Director in Treasury Strategies' London office, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. We're excited today to be joined again by our panel, whose organizations are also sponsoring this event: Martin O'Donovan from the ACT, Debbie Cunningham from Federated Investors, and Roger Merritt from Fitch Ratings. I will provide further background on our panelists before the panel discussion. Corporate liquidity has always been a key focus of Treasury Strategies consulting work with both of our corporates and bank customers, and it remains front and center with all of you and with regulators. As in the past, on this briefing, we will share with you the latest reports from the central banks on corporate deposit levels, what our clients are telling us, and discuss key game changers with our panelists and get their views on the implications for you and for the market. There's no dearth of topics to discuss, whether it's anticipated tapering of monetary policy by the central banks, unintended consequences of the Volcker rules, implementation of Basel III, money market fund regulation, and what appears to be a divergence in deposit growth. A quick review of the next 50 minutes. Tony's going to share the latest reported cash levels. I will then review highlights from our recent survey of banks around Basel III and introduce the game changers in the panel. Tony will facilitate the panel discussion, and then I will wrap up. A word before we get started: our 45 to 50 minutes today gives no time for live question and answers. However, we want to take your questions, so please type them into the question box in the bottom right-hand corner of your screen, either during or at the end of the webinar. We'll circulate the answers to all who have called in. Tony, what are the latest reports from the central banks telling us?
Thank you, Moni. Well, there's still a lot of cash out there. We're starting 2014. As you can see on page 4, the cash levels remain at absolute record highs. A couple of interesting things to note here, though, as we get the latest statistics on corporate cash. First, I'd like to point out, for the first time ever, in the bottom right-hand corner, we are showing statistics on Japanese corporate cash, which turn out to be just an incredibly large number, and we'll talk about that in just a second. Let's begin with the top right. U.S. corporate cash, as of the most recently reported quarter, is $1.93 trillion U.S. dollars. There's a 6% quarter-over-quarter spike in U.S. corporate cash. This is the highest recorded spike or increase in U.S. corporate cash ever. So something was going on between the end of the second and end of the third quarters there, caused corporations to increase their cash holdings by fully 6%, the most ever. And as you can see from that graph, the actual rate of increase, the slope over the last year, has been increasing at a substantial rate. Now, this is in somewhat contrast to the leveling off of corporate cash in both the UK and in the Eurozone, where we see about a 2% decline in corporate cash in the past quarter over each of those regions. And then as we take a look at Japanese corporate cash, you might notice how relatively flat corporate cash was in the earlier and mid part of the last decade, but seems to be on a direct trend line upward, relatively flat the last 2 quarters. But we're going to see how the quantitative easing that's currently kicked off in Japan will play out over time. Over the holidays, I was reading an interesting story about corporate cash, and a sort of tongue-in-cheek pundit wrote on his blog, very simply, is the reason corporations are holding so much cash is that central banks are printing so much cash that needs to be held. And at least to that pundit, it was very simplistic, that central banks are printing cash, it's got to end up somewhere, and corporate balance sheets are simply one of the places. We'll show you in a minute, though, just how much cash central banks are pumping up. If we turn to the next page, we can see we initialized the corporate cash levels at 100 at the beginning of the millennium, and you can see that the total absolute levels have doubled in the UK, in the Eurozone, and the US. There was a divergence over the last several years that seems to be closing now as corporate cash in the US seems to be making up for lost time. It's kind of interesting, though, that the Japanese corporate cash still remains very close to its historic levels, and only in the last couple of years started to increase. And as I said earlier, we will see with their latest quantitative easing in Japan whether that begins to trend upward. One of the statistics that we always find fascinating is the level of cash held by corporations in a country relative to that country's GDP. And we've looked at this for a long time, and in the U.S., cash as a percentage of GDP has gone up only slightly. In the last 13 years, cash has gone up from 9% of GDP to 11% of GDP, whereas in the Eurozone, we've seen about a 50% increase from 14 to 20. In the UK, 25 to 32, and in Japan, 36 to 49. Obviously, the Japanese cash as a percent of GDP is extremely high compared to the other jurisdictions. Some of our sense about why these numbers are the way they are, we believe that the numbers are high in the United Kingdom simply because of the heavy presence of global banks in the UK. The UK seems to be a central clearing area for funds around the world, and so banks are simply have cash in their UK operations. We'd be curious if you had any thoughts about why the numbers were so high in Japan. We're beginning to explore that, and we'll talk more about that in next quarter's cash briefing. Some of our hypotheses are maybe that the Japanese banks are simply sitting with a lot of cash, and that's sitting on their corporations' balance sheets. Maybe the Japanese corporations are using Japan as or global corporations are using Japan as a regional treasury center, so a lot of cash resides there for that reason. We'd be very interested in hearing your thoughts about this, however. So on the next page, we take a look at the reserve balances being held by central banks. And here we can see in the upper left-hand corner the reserve balances held by banks at the U.S. Federal Reserve. And this is a number that is skyrocketing, as you can see, since late 2012. The number is almost on a straight line trajectory here. It's interesting, you go from $1.5 trillion to $2.25 trillion over the 9-month period. This chart represents that is suspiciously close to $82 billion per month of increase in bank reserves. And I think it's no coincidence that the Fed's quantitative easing program was buying $85 billion per month of securities in the market. This may indicate a total sterilization of the quantitative easing program, where the money the Fed is creating has absolutely nowhere to go and comes directly back onto the balance sheet of the Fed. Now, if that is the case, that's certainly an issue for monetary policy and sort of what really is the economic purpose behind this kind of cash merry-go-round. Now, we also see bank reserves increasing in the UK, albeit at a much slower rate. Fascinating, we talked about this at our last briefing, the very sharp drop-off in European reserves. Reserve balances at the ECB are less than half of what they were a year ago. Now, you can see from this chart a huge spike beginning in about September of 2011, where the reserves more than tripled, almost quadrupled in a very short period of time. And that seems to have almost completely unwound. Again, later on, it'd be interesting to hear from the panel when we talk about central bank policy later in this session, what might be behind this huge drop. If this were a bank, or if this were a money market fund that had a chart that looked like this, regulators would say there's a run and we need to figure out how to stop it. The good news is this is a central bank which is totally in control of its own destiny, so the regulators aren't saying anything. But now, from the standpoint of a corporate treasurer, though, when you look at numbers that are moving, well, first of all, numbers that are this large and numbers that are jumping around so significantly, that certainly represents a challenge in terms of planning your balance sheet, planning your cash management, when so much of what's happening in the market today is being determined by regulatory policy, or excuse me, central bank policy, in terms of what the level of interest rates are, what the amount of liquidity is, and that creates an unknown in the minds of corporate treasurers or CFO, because whatever strategy they have, whatever strategy you have, can be made obsolete in an instant, simply as a central banker waves their magic wand. So this is certainly an issue, and I think we would all be much happier to be in a period where bank reserves look back in the 06, 07, early 08 era, where it was steady and predictable, and executives in both corporations and banks had a good sense of what the playing field was going to look like and operate accordingly. On page 8, we show the reserve balances at the Bank of Japan and at the Swiss National Bank. Again, this is just fascinating. Over the last several months, the Bank of Japan has really put its foot on the accelerator. And in fact, over the last 4 months, over the last 4 quarters, reserves just in 4 quarters have doubled. We know that under the Abe plan, there are plans for continued substantial easing. But again, when you have changes of this magnitude in such a short period of time, that certainly creates uncertainty on the part of the corporate CFO and treasurer. And then finally, in the far right, we have the Swiss National Bank, which has leveled off in the last year and a half. As most of you know, the Swiss National Bank, about 2.5 years ago, decided that it wanted to more actively manage the exchange rate, the Swiss franc, relative to the euro, and publicly stated that they would be very aggressive in their monetary policy to keep that rate within a specific band. And so it looks like they were very aggressive in the second half of 2012, hit their target, and have been flat ever since. I guess the point of this first part of the discussion, though, is to show that central banks are carrying an awfully big stick. When you look at these numbers, these are measured in like hundreds of trillions of yen and hundreds of billions of dollars or euro or pounds, if not trillions. We have vast amounts, a vast sea of liquidity out there that can conceive of what is certainly impacting the yield curve, impacting the rates, but also creating uncertainty, because as these funds move or get withdrawn from the system, we don't know what we're going to find once the water recedes. So on that happy note, let me turn it over to Moni for the next element of uncertainty on the minds of corporate treasurers.
Thanks, Tony. At this point in the briefing, we typically share with you what our corporate clients are telling us. But today we have some really interesting feedback from our banking clients. We surveyed them around their Basel III preparedness. So we wanted to share with you some of the key findings from that because we think it really has an impact, and will have, if it's not already having an impact on corporates, it certainly will. So Basel III, as banks look at what the impact's going to be, is going to have a profound impact on bank strategies with their corporate clients, and a particularly profound impact on deposit economics. So let's look at some of the findings from the survey. So we asked two questions with regard to banks' Basel III preparedness. The first was who is leading the bank's Basel III preparedness, and that's the chart in the upper left corner of the slide. And second was who is involved in the bank's preparedness or preparations, and that's in the lower right. So looking first in the upper left, so who's leading? And clearly we see Treasury, ALCO, and Finance are leading, with a few banks also having their business units lead. And this is not surprising to us, and that Treasury and Finance are really responsible for the bank's balance sheet. They're dealing with the regulators, so you would expect them to be leading the initiative. It's pleasing to see that some of the banks are having the business units lead, because the business units are really the ones that have the voice of the client in mind and really understand the client's behaviors and needs and what the impact of any changes will be as a result of the regulation to clients. But now if you look at the chart in the lower right-hand side, so that's who is involved. And you see more business units involved, but it's still the units that are the groups that are most involved. Risk is the highest, followed by Finance and Treasury. And less than 50% of the banks have the business units involved. Again, we think a concern, because it's the business units that need to be representing what the voice of the client. You know, in our work with our banking clients around Basel III, we find the banks that are implementing some of the most effective, or taking the most effective look at their Basel III strategies and what they need to be doing going forward, really have the business units, Treasury and Finance, are all working very closely together and in concert. And wisely, in that lower right-hand side of the chart, 32% are looking to outside consultants to help them.
Hey.
So we next asked which elements of Basel III represent the greatest challenge to deposit economics. And it's all of them. Now, a couple of them more so than others, and that's the liquidity coverage ratio and the capital requirements. But this just says this is a really complex issue for banks to address and understand what the Basel III regulation means to them, what the impact is going to be on all their products, and clearly on the deposit products. So every element of Basel III is impacting it. And then we asked if anybody was going to have a strategy to introduce new products in response to Basel III. And this slide is really interesting. So essentially everything you're doing, it says essentially everything you're doing with the bank is potentially going to be impacted. So 65% say they're going to be introducing new deposit products, and we've already seen some of those products introduced in the UK and elsewhere, and such as perpetual callable term deposits. So essentially it's a 31-day call, and it meets the requirements of the Basel III initiative. But then we also see 62% say credit products are going to be impacted, and 58% say transaction banking products. So again, all products are going to be impacted. So it's imperative that corporates be talking to their banks about what the potential impact is going to be on the services and solutions they're getting from their banks.
And Moni, I would say that the dark side of that cloud is that, so it looks like half to two-thirds of banks are going to be changing everything, every product line that they deal with corporate customers on, and the parameters for the product development with respect to Basel III are being laid out by the risk management side of the bank. It's the risk managers who are participating, and the balance sheet managers. So it's entirely possible that these products, these newer products, may not be as attractive from a corporate treasurer's perspective as products that they will be, the pre-Basel III products that they are replacing.
That's a really good point, Tony. Thanks for stepping in on that. Yeah, that is critical. So now let's turn to the game changers and then to our panel. On the game changers, we've selected 5 topics, and we're really not going to spend time on those until we get to the panel, but just to run through them. Monetary policy of the central banks, tapering, implementation of Basel III, which we just talked about, money market fund reform, the unintended consequences of the Volcker rule, and as Tony talked about previously, the divergence in corporate cash levels that we saw between the U.S. and UK and Eurozone. Now let me introduce the panel, and then I'll turn it over to Tony. So on our panel, we have returning Martin O'Donovan, who is Deputy Policy and Technical Director at the Association of Corporate Treasurers here in the UK, where he's responsible for the provision of technical guidance and regular updates to members, as well as representing the views of the treasurers to government regulators and the standard setters. They act as a professional treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Debbie Cunningham is Executive Vice President and Senior Portfolio Manager and Chief Investment Officer for Taxable Money Markets at Federated Investors, a leading investment management firm and pioneer in money market and fixed income funds. And Roger Merritt is a Managing Director at Fitch Ratings in New York, a leading global provider of ratings, commentary, and research. Roger is responsible globally for ratings on funds and asset managers. So Tony, I'll turn the facilitation of our roundtable over to you.
Thanks, Moni. Well, there's no shortage of things going on to talk about with our distinguished guests here. Why don't we start in the upper left-hand corner with the monetary policy. You know, as we know, the U.S. Federal Reserve announced a very modest tapering program of its stimulus. As we said earlier, the central banks have had their economies awash in cash, and I understand from Martin O'Donovan. Let's start with you on this, Martin. You were saying that because of the great amounts of liquidity in the UK, some of your constituents were unable to find banks who were willing to take their year-end deposits 2 weeks ago. Could you tell us a little bit about that?
Yeah, I mean, I suspect this is a mixture between that and the sort of Basel III type regulations, because I think the banks were probably looking to avoid grossing up their balance sheets by taking, being a very willing taker of deposits. So yeah, we did actually see some banks quite reluctant to take deposits over the year end. In a few instances, some negative interest rates. And in fact, adding yet another game changer to your list, the potential for negative rates becoming more prevalent in the year ahead. Well, that's another possibility, I guess.
Well, we'll definitely add negative rates to next quarter's game changers. Debbie, how did things look from your perspective over year end? Were you able to put your cash where you wanted it?
I agree with Martin. I think that the banks were disincentivized to some degree to be aggressive, rate providers and taking taking additional deposits. So there was definitely pushback from that perspective. I think what made it manageable, certainly in the U.S. especially, was the reverse repo program that has been being tested by the U.S. Federal Reserve, whereby they are temporarily on a reverse repo basis putting some of their bond purchases back out into the marketplace in the form of a collateralized transaction with basically non-traditional counterparts, and those non-traditional counterparts to a large degree being money market funds in addition to the GSEs in the marketplace. So I think that helped ease the crunch, if you will, in the U.S. and kept rates fairly steadily positive. But I can see Martin's point certainly about the potential, the greater potential for negative rates in the European segment.
Roger, from a ratings perspective, the amount of liquidity in the marketplace and the potential for tapering has to be something that you look at when you're evaluating an instrument. Is that right?
Oh yeah, I mean absolutely, Tony. I think as it relates to evaluating funds, obviously the key issue is can the Fed control interest rates in a coordinated, manageable fashion? The reference to the Fed's reverse repo facility, I think, is a good example of new policy tools that they're experimenting with to try and, I think, make sure that they can appropriately control interest rates, because I think in many cases rates had become divorced from the target Fed funds rate just due to all the quantitative easing in the market, and I think they were uncomfortable with that. So the Fed facility is one example of a new policy tool that they're trying to, I think, they've implemented in order to try and make sure that they can control rates as they start to roll back the quantitative easing.
So let's throw it out to the panel. What do you think the prognosis is for 2014 and the role of the central banks in providing liquidity or tapering and cutting back? Debbie, I know you have a thought on this.
I've always got my rose-colored glasses on for the most part. Being the traditional optimist in the marketplace, Tony. But I'd say we're a little bit more optimistic within the U.S. than we are in Europe in particular, just because the unemployment rate still in Europe on an economic basis is still pretty high. So there's a target rate or a target level from which the recovery has to continue to take hold in Europe that's sort of already been reached to a large degree in the U.S. So I think the likelihood of the tapering continuing, the yield curve steepening to some degree from a money market perspective, and the more sensible relative value in the marketplace, again from a short-term yield curve perspective, is pretty high, given what we think is good growth going forward. Certainly, the statistics that we've been told to watch and continue to sort of be developed are improving, and they're improving at a more rapid pace. So all of that seems to be a positive. And although I think Europe is not necessarily as positive from an outlook perspective economically, and therefore more of a danger in the context of negative rates and a less attractive relative yield curve, I still think the engine of growth at the U.S. helps pull all engines along, including the European one.
Martin, from your perspective in the UK, do you think monetary policy will continue to be aggressive, and do you think the ECB may, which is actually the one central bank that has contracted its monetary policy, may actually revert back to the mean?
Yeah, I guess I pretty much agree with what Debbie was saying there, that certainly within the UK, the Bank of England has been trying to hold rates down, giving forward guidance of its intention to do so by effectively linking its commitment to hold rates down until employment drops below 7%. Very soon after coming up with that forward guidance, employment rates did actually start falling. We haven't reached 7% yet, unemployment rather. So it, to some extent, it rather backfired in that some of the longer-term rates have actually started going up. But I think there's no doubt that the shorter-term end of the yield curve will stay low. Probably in the UK, negative rates, not too likely. I guess in Europe, it's perhaps a little bit more of a risk, because the rates there are exceedingly low. and you do wonder whether it would take much to tip things even further.
And Roger, if the rates do go negative, what does that mean for the funds?
Well,
how does this work?
Well, it doesn't make it easier for the funds, that's for sure. We've already, I think, faced that possibility in Europe, and Debbie can certainly chime in. But I think funds have in Europe have faced the prospect of negative rates, and many have taken proactive steps to be able to account for that in a way that they can maintain a stable net asset value even if rates go negative. Obviously the attractiveness of the product as a cash management tool, becomes even more challenging in a negative rate environment. From a ratings perspective, we've clearly stated that that's a market phenomenon. It doesn't, and it's not, and therefore it would not in and of itself have any impact on the ratings of the funds.
Interesting. Let's move on to some of our other game changers. And one that I want to put in here, the Volcker rule. As most of you know, on December 10th in the United States, several regulatory agencies voted to implement the Volcker rule, and it is now the law of the land in the U.S. To those of you outside the U.S., the Volcker rule and Dodd-Frank have regulatory ambitions that go well beyond the U.S. borders. So this really is a global impact. So after years of weeping and gnashing of teeth, the rule is approved and becomes official on December 10th of this past year, with the conformance period going into 2015. We were kind of taken aback at Treasury Strategies 2 days ago on two events. One is our partner Kathy Gregg has been invited to go down to Washington tomorrow to facilitate a discussion among selected members of Congress regarding the Volcker rule. And another Treasury Strategies partner has been invited to testify next Wednesday to the House Financial Services Committee regarding the Volcker rule. And so we're kind of reading between the lines. It sounds like the U.S. Congress might be not satisfied, let's say, with what is transpiring. And I know that there's been a hue and cry in the last couple of weeks over a couple of aspects of the Volcker rule. And Debbie, you've been on top of a couple of those. Perhaps you could share them with the group.
Sure, Tony. And I do think it was mentioned by both Moni as well as Martin earlier in the presentation that because there's so many things impacting the market and banks in particular, Basel, Volcker rule, it's sometimes tough to actually, sort of separate, what specifically is due to Volcker changes and what might be, more reflective of Basel changes. So with that in mind, I think probably the two areas that from our perspective we seem to continue to be addressing have to do with the ABS marketplace, so the FX securities marketplace, ABCP in particular, and then the TOB financing market in the municipal sector, both of which I would say seem to be on a positive momentum track to finding alternatives around or reasons for continuing to exist, maybe in a modified form, despite some of the negatives associated with those, with the Volcker rule and with Basel III. So even though some of the capital charges and some of the things from a Volcker perspective that would be problematic in the ABCP market for the large banks that continue to offer those types of programs in the marketplace, we're getting feedback from at least a handful of those large banks that they would continue to look at this as something that might just be less profitable for them, but in the context of actually stopping those types of programs. It's unlikely that they would do so, just simply because, they kind of look at it more as a full package of operations to offer to their corporate cash customers. So, we're not in dire straits thinking that market will disappear. And I guess the same is true from a TLB financing perspective on the muni side, that the innovations that seemingly are being discussed at this point to kind of work around the rules we're pretty optimistic about them succeeding.
Good, helpful. Let's move on to the implementation of Basel III, which is clearly impacting around the world. And perhaps start with Martin here. You mentioned Basel III and sort of balance sheet ratio maintenance as perhaps one of the elements behind the year-end reluctance of some banks to take on deposits. Could you share with us what you're seeing broadly in terms of Basel implementation?
I think in terms of some of the game changers that you got there, this one has to be the biggie. I mean, things like Volcker and the UK and European equivalent, they're big, particularly big for the organisation of financial services firms themselves. But, by hook or by crook, markets will continue to go on. Some of the overheads and the bureaucracy might change. But when it comes to Basel III, that really is fundamental in addressing the capital levels the bank has to hold, and the liquidity really will drive what they're able to offer their customers, and indeed what they'll charge for offering that. I mean, particularly in the sort of areas that we look at on this call, the basic interbank, the money markets. If a bank is funding itself relatively short term, just for less than 30 days from the interbank market, that really virtually counts as not providing adequate liquidity for the bank, and it pretty much counts as nothing, even to the extent that interbank funding at that level really doesn't count as liquidity. Corporate deposits with a bank will in that sense be a little bit more valuable and useful to the bank, but the trouble is they'll far prefer longer maturities than periods less than a month. So we expect to see, well, I think it was mentioned earlier on by yourself, that new products will come along, these sort of evergreen type facilities, so that you put your money on deposit, and it's sort of, the terms and conditions are such that you would expect it to last more than 90 days. There might be some facility for getting it back, but if you don't call it back at the end of the 90 days, it sort of rolls on. Yes, we will see those. Well, we already have. So treasurers who might want to keep their deposit levels relatively short term will suddenly find that the banks aren't really takers of short term money. They actually want things that are a touch longer to help on their liquidity and funding levels. I mean, of course, it also affects the borrowing side. If a bank lends to a corporate and has to hold capital against that, to the extent that's weighted more onerously, that has a cost. And again, we're seeing banks already adjusting and planning for that, even though some of the actual rules come in over a period of years.
Roger, from a ratings perspective, you're obviously concerned about how much risk an institution is taking, and the quality of their balance sheet. How does Basel III impact the way you're evaluating the financial institutions that you take a look at?
Well, maybe I'd actually like to first just come at it from the perspective of the corporations, because I think it's really important to underscore what Moni and Martin said, is that this is probably Basel III is probably the biggest issue for corporate treasurers and cash managers, because and we'll talk about money fund regulation in a bit, but the combination of fundamental changes in money market funds combined with the fact that what used to be called relationship banking, where banks competed heavily to get corporate deposits, even on an overnight basis, in return for various services and credits, that world is rapidly disappearing. So, if you're a corporation who's accustomed to parking your money overnight at a bank, and that's your primary cash management strategy, you're really going to have, and you're really going to have to fundamentally rethink how you approach cash management around the world. So, from the perspective of ratings on banks, I'm not a bank analyst, but I think anything that increases liquidity and capital is in and of itself a net should be a net positive from the risk profile of the financial institution. But then you have to weigh that against the fact that there's other things going on, in particular the level of sovereign support that's always been a factor in our ratings is, that's changing at the same time. So you really have two competing forces underway.
It's interesting that you bring up the term relationship banking. At Treasury Strategies, we've coined a new term that we call compliance banking. And we actually believe that the market is moving. The days of relationship banking are over, and the days of compliance banking are just now in its infancy, where it's all about checklists and ratios and numbers. And I remember when I started in banking, there were 3 C's of credit: character, capacity, and collateral. And it looks like under Basel III, character goes away as having any relevance at all in the evaluation of credit. Anyway, enough editorializing. I'd like to move to Debbie and money market fund regulation. In our last segment here, 2013 ended, no new regulations, so another year has gone by. And we're getting the sense that the conversation among the regulators might be shifting a little bit, and the VNAV may actually not be the great idea that the regulators thought it was, and they're beginning to understand that. Am I wrong about that, Debbie?
No, I think you're absolutely right, Tony. We've felt that shift. We have heard that shift. We've seen that shift. So, I would confirm agreement with your thought. It certainly seems as though that's being felt by others too, and we received what I'll call warning to some degree in early December that because of that perception at the current time, which may not necessarily be completely palatable from a Fed perspective, that we were going to start seeing a lot of pushback and be prepared for, to some degree, an assault by the Fed in the marketplace about that particular shift. And we have certainly seen that. We've seen the letter from Boston Fed President Rosengren a little over a month and a half or so ago. We've certainly seen some blogs from Liberty Street Economics, which is the Fed's blog, the New York Fed's blog, along those lines, basically saying to paraphrase that if gates and fees are the ultimate answer, that's a worse answer than no answer at all. That's a worse response than no response at all. So, we're feeling that barrage, we're seeing it, but we're also fairly confident from an independency perspective with the SEC and the understanding of that particular agency as to this regulation specifically from a money fund standpoint here in the U.S., that it should not be, that they can withstand the barrage. So we're pretty confident at this point. I'd say the other point to note also, Tony, is in the non-U.S. marketplace. Certainly the European market, we have been looking less optimistically at the proposals that have come from there because they do include 3% capital as the only way that CNAV could continue, otherwise VNAV being the only option. But we're actually starting to see a little bit of light at the end of the tunnel that there are ultimate impacts to their economy and to the users from a corporate perspective, from a public sector perspective, that would be problematic if it in fact proceeded with just those two options as the available propositions to implement. So we're feeling a little bit more confident in the European marketplace too, that the potential arbitrage of locales with similar products but different requirements maybe won't come to fruition.
Great. Now, Martin, the clock is running out on the European Parliament, though, to address this in the current session. How would that sort of play out over time?
Yeah, I mean, I think they certainly have a priority to try and push this through. Our European parliamentary session comes to an end. I think it's sort of April-May time, and then we have new elections, and the sort of political system is such that everything pretty much grinds to a halt over the summer, and legislation that failed to get through in the old Parliament pretty much has to start again under the new Parliament when that comes together. So it might very well not get through, given timescales are relatively short now. I'm actually encouraged to hear Debbie's comments, because we had thought that there might be some leeway over the proposal where they were going to ban money market funds from getting themselves rated. That we thought was exceedingly unhelpful, but we thought we might make some progress in getting that bit reversed. If the bit on capital could be watered down or moved towards liquidity gates and fees, that would be very pleasing to our members, because money market funds are serving an incredibly useful purpose and are heavily used. And certainly the proposals as we saw them didn't really address the issues.
So, Roger, you're rating funds in both markets. What's your outlook here?
Well, I think I would just echo what Debbie and Martin have said. I think there seems to be some willingness to accept that. Well, while I think we all appreciate that the regulators have some good faith, concerns about systemic risks, that maybe some of the things that they propose aren't the panacea that they thought they were, and that there seems to be some openness to reconsider some of the more, I guess, problematic aspects of the proposals, both in the U.S. and in Europe. So Martin mentioned the ban on ratings, which we hear time and again from treasurers that we talk to that they value the ratings, the independent oversight and monitoring that comes along with the ratings. So I think there are some positive signs that we can look to.
Interesting. Well, we've covered a lot of ground today. Thank you all. Let me turn this back to Moni to kind of summarize, tell us where we've been, and share with us where we're going.
Okay. Thank you, Tony. That was a great panel discussion. Lots of topics covered. Let me see if I can point out some of the key things. So, I mean, I think we started out with the fact that corporates are, particularly over year-end, are having trouble placing money, certainly in the UK, and I think we heard that was happening in the US as well. So whether that was due to banks were not willing to be aggressive on their rates, but whether that was due to anticipation of Basel III or early quantitative easing signs, it's uncertain, but certainly a concern as we go forward about where the corporates are going to have trouble placing their deposits with banks. In terms of quantitative easing, there's some concern as that begins to happen, what's going to be happening to the rates as they begin to become more tied to the Fed funds rate, et cetera. But I think it's a bit of a wait and see right now. I think most concerned in Europe where the rates are the lowest, and also where they're actually the European Central Bank has already been fairly aggressive and tapering on the quantitative easing. In terms of the Volcker rule, agreed that it's a bit onerous for some banks, and for the market, but there seem to be ways certain entities are getting around it, and not nearly as impactful as everyone sees Basel III. Basel III really profoundly impacting all aspects of corporate relationships with banks, whether it's borrowing money or whether it's placing deposits. So it's going to be interesting to see what happens there, and will it become compliance banking versus relationship banking? And then the other thing that I think that's really interesting that came out was just on the money market fund regulation, that there seemed to be some cracks, and the regulators' certainty that what they propose is what's going to save the world. So we hope those cracks will get a little bit bigger. Tony, would you add anything else before I wrap up?
That was a great summary.
Okay.
And we also got some good topics for next quarter.
Right, right. So again, thank all of you again for joining our quarterly cash briefing, and a special thanks to the panel. You get even better. You get better each time. So thanks to Debbie, Martin, and Roger. Look for our invitation to the briefing next quarter. And also for corporates, while we presented a survey from our banking clients this year, we will be going back out to our corporates and want to make sure we're representing your voice and hearing what your plans are. Thank you, too, for your questions. We'll answer and circulate to all who registered, and we'll also send you a copy of the report. We encourage you to look at our sponsors' websites, so ACT, Federated, and Fitch, and also to Treasury Strategies website for further articles and commentary, and to reach out to us if we can be of help with your liquidity, forecasting, or technology strategies as you continue to navigate this uncertain but interesting world. Thank you.